My name is Mike Marks. I'm the hired help for today. That's the subject. Not that it's an issue with anybody, but as one manufacturer buys another, and what impact does that have on distributors? I'm going to encourage you to download a copy of this presentation. You got a hard copy in front of you, but there's a lot of links in this that if you download it, and this is in the slides you've got, just underline the deal. You don't have to tell us who you are, but you got to plug in your username, which is NAED space regional, all caps, and your password is consolidate. So if you do this, I'm giving everybody here copyright permission, do whatever you want inside your own company. Go in peace. And there's a lot of links, as I say, so you can just click on the links instead of having to type something in. I know a lot of people in this room, not everybody. I have been in this industry for 30 years. We have done a lot of work for the CAP Council. I've got probably, I shouldn't say I've got, our firm probably has 50 non-disclosure agreements with manufacturers and distributors in this room. Not in this room, but in this industry. We've worked with the majority of the top 50 distributors and probably all the big manufacturers at one point or other. So I teach the merger and acquisition courses at NAED's University of Innovative Distribution, and we do a lot of this kind of work for people. So, and I like cars. And by the way, just since we're recording this, I also have to mention that I hate Delta Airlines. Delta Airlines is an acronym. It stands for Don't Ever Leave the Airport. And they have abused me many times. And I know this is not part of the presentation, but I've got so much agita about this. Every time I do a presentation, I just like to share it. I believe that whatever airline you fly the most, you hate the most. So I feel better now. Thank you. Talk a little bit about a big picture, but I really want to walk through the money. A lot of what this is what's driving this behavior is money and what people have to do to make the money work. And if you understand what's underneath the money, it's a lot easier to figure out what people are going to do and why they're doing these things. So we're going to focus a lot on the money. And the key thing here is that if you're an owner-operator, I'm the owner of the capital, I'm the senior executive, I can do pretty much what I want. It's good to be king. If you're the CEO of a public company, in other words, you're not the majority shareholder and somebody else is, and they don't get the growth that they want, does everybody understand it becomes career limiting for that CEO, right? Yesterday was your last full day, and it's just full-time temporary work for some of these guys. So they have to generate growth. Think about the money and the return that you get in your 401k or whatever your investments are. You know, if you go to banks now, in big parts of the world, you got negative interest rate. There's so much volatility that if you want to protect your money, it costs you money to have somebody protect it. That's what the negative interest rate is. So you want to put your money in stocks that are going to grow and develop. So people have to have a story. And if they don't grow, they sell the stock and then the company goes away. So they have, the key point I want to make here is that they have no choice. They must grow. So this is important. I've been around this long enough. I remember Jimmy Carter and the misery index. And I was a manufacturer's rep at the time. And what was really cool about it, with all this inflation, my commissions kept going up. I loved it. And so if you look at growth, there's only a handful of places you can get it. There's basically three and a special one, which are up here. I can get inflation. Inflation's good, I get to show growth there. I can participate in underlying market growth. The industry's growing at 5% a year. Rising tide raises all ships, so I get to generate growth. I can also get it from share gain. In other words, the industry grows at 5. I mean, if you look at this industry this last year, if your sales are down 3%, you're gaining market share, right? I mean, everything's relative. But the point is, if I can't get inflation, if I have underlying growth that's negative or flat, right? This is the NAW euphemism, flat growth. This is an oxymoron. It's two words, you put them together, they make sense. You put them together, they don't. It's like mature male, Army intelligence, flat growth. I mean, it just doesn't work. So if I have to get growth and I have no choice as a condition of my continued employment, the only way I get it share gain, and I have to go buy it. I have to have growth. That's a given. So when you talk about manufacturer consolidation, If I can't get the market growth, I can't get it through inflation, I can go create something truly new like Uber, right? That's something very different. Now, here's the interesting thing about this industry. All the manufacturers in this industry are considered pipeline manufacturers, not platform manufacturers. Uber's a platform. There's a lot of work now going on. A pipeline company says, I engineer, I make products, and I have a pipe through, I have channels, and I'm pushing this through to end users. I got this pipe, I fill it up, I just push as much stuff through it as I can. A platform's a whole different deal. So we've got all these pipeline, and the thing you need to understand is that there's 129 NAEDs in the National Association of Wholesalers. All are in a different stage of consolidation. They're all consolidating. The way you measure consolidation is you say the top 10 competitors in the industry, if I'm talking about distributors, you guys have all seen the list, the top 10 competitors in the industry, what percentage of the total revenue do they represent? As that number gets bigger, it means there's consolidation. In the electronics industry that I came out of, there are 4 distributors that control 85% of the total spend in the industry. So we're a long way from that. But when you start going through looking at this is a chart, and I want to talk about this disease. It's called the Walmart disease. The link's down here. It's from Forbes magazine, has a whole thing they do on this. This is the value of a share of Walmart stock from 2000 up to 2011. When Sam Walton came in and built the supply chain, that's what today, you notice there was like a quadruple increase in share price. It wasn't a big revenue increase, but there's a quadruple improvement in share price because they built a supply chain model. They built the first large-scale pull model instead of push model. From 2000 on, the company has quadrupled in revenue and created virtually no shareholder value. It's empty growth. They have quadrupled they do over $1 billion a day in revenue. Over $1 billion a day with no increase in shareholder value. It's called the Walmart disease. They do one thing really well. They do everyday low prices, right? So think about the horse that can add, subtract, divide, and do square roots as long as the answer is 3. They got one thing really good, and they didn't change. They got rigid and held hostage to it. And so what happened now, Walmart acts just like a bond. They have a dividend just like a bond to their shareholders because they've been unable to create any shareholder value. There's a thing called empty growth. It's really important. We're seeing empty growth issues going on in the industry today. Here's part of the problem. Remember I said there's inflation, there's underlying market growth, and there's share acquisition. Those are the 3 core ways you grow a business. McKinsey just came out with this in May, McKinsey Insights. They did a study on global growth. Like, we could spend the whole afternoon talking about this chart, but I'm going to talk about U.S. equities over here. And what they're basically saying, if you look at historical returns, we've had a 7.9% return, financial return, on the U.S. equity markets for the last 30 years. The last 30 years have been higher than the last 100 years. In other words, if you look at the blip, things have been really good for the last 30 years. How old were you 30 years ago? Right? I was much different. What they basically said is that we're looking for the next 30 years at lower growth. If we have, and these 2 numbers here are really important. This is the global for the next 20 years, and it says if we have a robust economy globally, or economic recovery, because right now everybody understands we're in this flat growth thing or even recession. If we have a robust recovery, including emerging markets, we're looking at the next 20 years at a 6.5% growth rate. We're back to the 100-year average. If we do not have a robust recovery, and most people are betting against it right now, we're looking at 4%. So if I'm in a public company and I have to get growth, and I'm looking at the next 20 years of even lower expectations, what pressure does that put on me to buy more of my competitors? I have to get growth. I have no choice, or my job goes away. Doesn't matter. So we've got this slow growth scenario. We've got all this empty growth going on. and here's what you got. I'm sharing something from my friend Jim Lucy, who runs electrical wholesaling, and he's been here since dirt, like me, and he's got a little index that I found when I started to put this together. He goes back to all the electrical brands. And what hit me when I did this is that we have been losing brands in this industry since I was in it back in the 80s. And it's listed all in one place, and I'm old enough I actually remember a lot of these guys. And so what we're seeing now is an acceleration, but it's not new. It's a lot more intense. The consequences to distributors are a lot more intense, but this has been going on for a long time. So there's an iterative process that you go through when you're trying to generate growth. I need to have growth. I can't get it organically. I can't get it through inflation. So I just go out, I buy another company, I rationalize expense. You get to the point of diminishing returns, and we're almost there now. You're already seeing a transition to phase 2. I can mention some big manufacturers and think about what they're doing in terms of divesting parts of their business, taking that money and acquiring new other companies. Probably the highest profile right now is GE, right? You guys been following that? They're all over the place. They've been spinning off all kinds of things, and what they're basically doing is they're putting money where they think we're going to go stand in the light of market growth. And so what I'll do is I'll spin things off, I'll buy new things that have higher structural growth, that gets me the growth. What happens, that goes away, and then we go right back to phase 1, and we just keep going through we've been going through this loop for 100 years. That's how it works. And right now you're seeing bits and pieces, but the key thing, you have to have a story for investors or they sell the stock. Joseph Schumpeter, actually, I won't go there. People like stories. If you look at stock market multiples, they're all about hope. It's all about what people think are going to happen in the future. Everybody in this room knows somebody that's always talking about the market and where to put your money and what to go, and sometimes they're right and sometimes they're not. And by the way, Alliance, there's a ton of Alliance people here at this other convention. Have you guys noticed there's another meeting going on here too? We do a lot with risk assessment in our consulting practice. They put this out every year. And there's a whole profile. What are the major risks if you're doing business globally by country, and how does it all look? And they're talking about this fourth revolution. And Alliance just came out with this. It's their 2017 profile. And they're talking about this Internet of Things. People are having all kinds of words about it, and it's dramatically changing everything. This is bigger than what the Internet did. Right? I mean, I know there are people in this industry who still think the Internet's a fad and it's not going to stick. And there's some people that still worry about their fact strategy. But this is kind of like the next big thing. And by the way, these end up being zero-sum games. People win, but they lose at somebody else's expense.